Hello everyone, welcome back. So today we're going to be talking about the concept of order blocks. Before we get into order blocks, we have to understand premium and discount arrays. These may be commonly referred to as PD arrays, so premium discount arrays, and they're basically areas where we could trade towards and trade away from. So we could trade towards a premium array, and after we trade towards that premium array, we could target a discount array right here. And this is the same thing for discount arrays. So we could trade towards a discount array. After we reach our discount array, then we can target a premium array. So essentially, premium arrays are just high prices and discount arrays are low prices. You want to look to buy in a discount array, and you want to look to sell in a premium array. So if we're trading away from a premium array and targeting discount, we want to be looking to sell. And if we trade it to a discount and we're targeting premium, you want to look to buy. So moving on to the concept of order blocks. Order blocks are basically orders within a block. Well, you might be thinking, whose orders? So these orders are from these big institutions, these banks, these hedge funds, these private equity firms, the big players in the market. And they need to be doing the exact opposite of what the market is doing. They want to buy and sell, they want to buy the sell orders, and they want to sell in the buy orders. And this creates order blocks. So institutional orders. Because the institutions, their orders are so big, they need so much counter liquidity, so they need counter orders in the market. So if they're looking to buy, they need a lot of sell orders in order for them to fill their position. So this brings us to the concept of order blocks. So how can you spot an order block? In a bullish order block, it's actually pretty easy to spot. In a bullish trend, you want to be marking the down candle, not the up candle. We want to be marking the down candle because you got to remember institutions are doing the exact opposite of what the market is doing. I'm going to give you a couple seconds to see if you can find the order block on the screen right here. All right, so the order block is right here. And as you can see, price came back and then continue higher. So that's another thing. Price can return to this order block and then continue higher because the market is always looking to do two things. The market is either seeking liquidity or offering fair value. We're going to cover more on this topic later. But you have to keep in mind that this return is not going to happen 100% of the time. So an order block can be valid without the return. All you need to know is that in a bullish trend, we're marking the down candle. In a bearish trend, we're marking the up candle. And here's a little golden nugget for you. So if you realize that this wick right here is overlapping with a fair value gap, well, now you might not know what a fair value gap is right now, but you will learn it in the future, so don't worry. So once you learn fair value gaps, come back to this video and this will make a lot more sense. So if the order block is overlapping with a fair value gap, then you want to mark out the wicks. So you want to include the wicks into it right here. So this is what a bullish order block would look like. Now the next thing I want to show you is a bearish order block. So in a downtrend, so if price is looking to target discount arrays, so we're looking to go lower, you want to be seeing the consecutive up candles instead of looking at the down candles like we covered last time. So with my criteria, you can see that the order block can be located right here. I see an order block right here. Is it overlapping with a fair value gap? Yes, it is. So we want to take the wicks of the order block right here. And as you can see, we did return to it and then continue lower, but you also got to remember we're not always going to have this return. So remember that an order block can still be valid without the actual return. Now, the last thing I want to cover is MT. So I'm just going to use the previous two examples. So let's start with the bullish example first. So MT is basically short for mean threshold. Mean threshold is just the 50%. So the halfway point of the order block must be respected, ideally. Based on statistical data from other people that have backtested, they've concluded that the mean threshold is a real thing. So ideally, we shouldn't see a candle close below the mean threshold. So I invite you to draw your Fibonacci tool from the high to the low, and the 0.5 would be the mean threshold area. Now moving on to the bearish example, we can do the same thing. We can take out our fib tool. We can mark it out from the high to the low. So this mean threshold area is where we shouldn't want to see candles close. So we shouldn't see a candle close above the 0.5 area. We can see a wick into it. A wick doesn't really matter. We shouldn't see a candle close, but we can see a wick. Now, the last thing I'm going to leave you with is that not every single order block will hold. You might see that the return comes and we continue lower, but you get faked out and you instantly continue higher. You have to understand that trading is a game of probabilities. Nothing is certain. Although we know that the market is a very efficient place, there will all there will always be inefficiencies in the market. That is all for today. I hope everyone learned something from this video, and have a nice day.